I know. It is a little bit tight up here. Yeah, I'll switch you. Give it just a couple more minutes and then we'll get started. Thank you for who's joined us online. We're excited to have you guys here. So give us just a couple more minutes and we will get this show on the road. I think we still have some people in there getting food, right? Okay. Okay. All right. So we're going to go ahead and get started. I want to thank you guys for coming in today. I'm super appreciative of you coming and learning more about creative financing. So we've got some really great products that we're going to show you. I do want to introduce Tiffany. She is our great title partner and sponsor. So thank you, Tiffany, for being here. Did you have something you wanted to?
Let me talk to you guys just real quick. So I'm with Iron Title, and you haven't heard of us. We are a group of industry veterans that all came together and decided that they wanted to create something that could be benefits. So we have amazing escrow officers that give white glove service because for you means that communication, that responsiveness, and officer. And then you've got me in the marketing department. I'm on the sales team as well. We're coming on Glendale, but we really want to make sure that we're helping you build the business. So we'll sit down with you, look at what you're doing now, what's working, what's not working, what could you do better, how can you leverage technology. And I'm all about low cost, efficient, ways to make it. So I will follow with each of you after the class and
Awesome. Thank you.
Thanks for having me.
Oh, yeah, for sure. And I will say that there's two of our escrow officers that I have worked with that are amazing. They're veterans of our industry and they're very professional. And I will tell you that Terry can do wonders on manufactured homes. So you ever have a manufactured home situation, Terry is your girl. I think the world of her, and of course I've worked with Brandy for a long time, so she's amazing as well. So, but thank you so much for helping support us, and I really appreciate it. And then of course the star of the show, Patrick. We love having you here, Patrick. I've known you now for quite some time, but not quite as well as some of our other little officers in here, right? So, but Patrick, you used to be working here at Guild, which we miss you. So anytime you want to come back, you can. But he actually now does an incredible job for Bankers Trust. He's going to be talking to us about some really cool stuff that they've got going on there for self-employed entrepreneurs and really your everyday banking client. So I think the information that you're bringing to us is very valuable. So I'm excited about it. And tell us a little bit about yourself for those who don't.
Sure. Oh, yeah. Again, no pressure. I want to thank you for having me out. I'm very excited to be here. I joined with Chris a couple of years ago. I was actually sitting here listening to you do a lunch and learn and coaching, and for lack of better term, kicking us in the butt and making sure we're doing our calls and whatnot. So
I try.
Yeah.
Try.
So I'm Patrick. I work at Bankers Trust. We are a small, well, actually mid-sized now, I should say. We're a privately held bank out of Des Moines, Iowa. You've ever seen the tractor trailers, 18-wheelers on the road with the RUAN on a Ruan? That's the family that owns Bankers Trust. Staple out in Iowa, 105-year-old bank. We're a boutique-style bank. We've been in Phoenix now for about 15 years, almost 15 years actually. So I joked with Tiffany on the way in when I saw the flyer out of and it's a great job of helping out, great and everything, but wanted to make a disclaimer before you the financing. Unfortunately, I'm not going to be your person for your 588 FICO borrowers. Just the opposite, actually. Private banking is defined at bank with trust as 250,000 or 1 million net worth. I did bring my colleague here, Jason, with me. Jason's one of our retail relationship bankers. If you or your clients don't fit the criteria of private banking, Jason's more than happy to help as well. We've got a stack of checking account applications we're going to make you all sign before you leave here. So again, I personally work with those that are 250,000 household income, 1 million net worth. We're going to get into a little bit of financing that we can offer for those types of folks. But if you will, I'm going to ask you to either write down or maybe think about throughout the presentation. We'll address it at the end. Perhaps your biggest pain point when it comes to your bank, your personal bank. Expecting everyone to start jumping things down right away here. But yeah, we are going to present on three main topics. We're going to talk about FDIC. Everyone knows what FDIC stands for. And I joke that when people ask me why I got into banking, especially coming from mortgages, I add some humor, right? I got into banking because it's notoriously slow, boring, conservative, but some of the larger publicly traded banks have changed the course this year for that and put us in the headlines, not us, Bankers Trust, but so when it comes to FDIC, or you know what, let me first, Annette, if you can go to my next slide here.
Yeah, sure.
Yeah, so we're going to talk FDIC. We're going to talk about a little bit about expanding your coverage on personal account types to $3.5 million, and for your business and commercial accounts up to $150 million. We're going to talk a little bit about private banking services, customized deposit and lending solutions, and banking. Maybe Annette can attest to this as well. In mortgage, we're notorious for throwing out jargon in terms that we just expect everyone to know what it means. What is private banking? You see in big banks, they have private client services. So we'll get into a little bit about that too. And last but not least, some of my favorite, really why I love what I do now, we're going to talk about BTC Trust Company of South Dakota. If you're not familiar with some of the statutes in the state of South Dakota, very favorable when it comes to privacy laws, very favorable when it comes to tax mitigation. For example, no state income tax, no capital gains tax, no estate tax in South Dakota. Still got to pay on the sample, still the United States state. So I'm going to give you some case studies of ways we've been able to help business owners when it comes to our South Dakota Trust outfit. It's under the umbrella of Bankers Trust. So I'm a big fan of injecting humor. I am destined to make banking fun. Banking is notoriously boring and slow. So I'm not a big fan of asking everybody what their favorite color is with icebreakers around the room. I am a big fan of humor. Hopefully you'll like me more if I inject some humor. So if we can go to the next slide. Who here, you just got out of tax season, who filed their taxes on time? Yeah? Anyone didn't file their taxes on time? Anyone brave enough to? Okay. So, extension, okay, you're brave enough to admit it. This is a legitimate publication, number 17 on the IRS tax law. It says, illegal activities, income from illegal activities such as money from dealing illegal drugs must be included in your income on Schedule 1, Form 1040, line 8Z, or on Schedule C, if from your self-employment activity. Furthermore, stolen property. If you steal property, you must report its fair market value in your income in the year you steal it, unless you return it to its rightful owner in the same year.
Oh my God. Oh, wow.
Legitimate tax code. My favorite part about the first one is actually the last part, right? So on Schedule C, if from yourself, so to me, that almost reads like the IRS is directing you on how to structure your illegal drug enterprise, right? Like, if you're so open to work doing drugs and you're not gonna have an EIN, just use the social and put it through Schedule C, right? If you have some more complicated pass-through entities, talk to your CPA. And anyone steal property in year 2022? Better yet, does anyone steal property and return it to its rightful owner? We need to follow you from one tax. All right, so next slide, please. Mind Annette. Elephant in the room. March, we had 2 banks fail. Silicon Valley Bank is the 16th largest publicly traded bank in the United States. Again, I'm a big fan of relating it in simple terms. So the very premise of banking is a Bank of Patrick is a broker, right? Your name, ma'am?
Kim.
Kim, okay. Kim has $100 that she wants to deposit at the Bank of Patrick, right? I'm going to use Anna. I'm going to pick on Anna. Anna needs a loan, right? So she needs a $100 loan to fill up her tank for a gas, right?
Yes.
Right.
Yes.
Exactly. Okay. All right. So
Definitely.
in order for me to entice my depositor to deposit money at Bank of Patrick, I have to pay her a rate of return for interest. I get to take her $100. I get to loan it to Anna. I'm going to charge Anna 10% on her gas loan. I'm going to take that 10% interest. I might pay you 2% on your checking account. I'm going to keep the 8% myself and walk away, right? That's how banking works. That's how we make profit, right? If a bank can't make enough loans or sufficient loans, we can also purchase investments. Silicon Valley Bank made a poor investment choice, right? They purchased long-term debt, paying them a fixed rate of return in a heavy way, very exposed to it. So let's say if I were to buy long-term treasuries paying me, I don't know, 3% or whatever, and I still have to pay my depositors because inflation goes up. What happens to the value of the dollar when inflation goes down? Value of the dollar goes down, value of bonds go down. I'm taking in less than I have to pay out, right? Silicon Valley is a publicly traded bank. They are required to have quarterly earnings calls. They are required to put out their statements of operation. Shareholders, stakeholders, Silicon Valley Bank customers caught wind of this poor business choice. They said, I'm going to run down to the bank and take my money out because I don't want to be the last depository of Silicon Valley Bank. And they had a bank run. Clear as mud. I wanted to simplify that. But you know, in short, poor investments on debt, unstable deposits. But if we can go to the next slide, that fast forwards to a little bit about Bankers Trust here. So we are privately held. Even though we're privately held, we still believe in honor and ethics. And we publish our 2022 annual report on the front page of our website. A little bit of a snip here of our statement of condition. We are full service, consumer and commercial banking, wealth management, trust services. We're very well capitalized, as you can see. We run a very conservative balance sheet. We are a $6 billion, going on $7 billion bank. So I can't, and maybe Annette, you need to stop me if I get on a rabbit trail here, because this idea of too big to fail, right? The most common thing I hear is people coming over from other banks is, well, Patrick, I feel more comfortable at the big banks than too big to fail. That's why I have a little bit of a problem with that because I won't pick on any audience members. Let's see. Let's just say pre-banker Patrick, pre-dad Patrick, pre-husband Patrick used to enjoy adult beverages in his early 20s, right? What happens when we enjoy too many adult beverages? We wake up the next morning with a hangover. We always say when we wake up with a hangover. Anyone? Never gonna do this again. Right. What are you doing by Friday?
Yeah.
You're doing it again.
Yeah, doing it again.
Okay. So that's a little bit like banking with big banks because they're too big to fail, right? You know, one day it's, you know, hey Patrick, they opened up 6 checking accounts in my name without my permission. Or fraud here, corruption there, and oh, I went to my bank for a PPP loan and they totally fumbled it. I went to the community bank, still banking for big bank though. So we're going to talk about Bankers Trust, but I'm also here to be your wingman and not having more banking hangovers, hopefully. So, and I don't know about you, but I want a little bit more degrees of separation between my money and too big to fail. Silicon Valley is the 16th largest bank. I'm not here to talk to other banks, but let's go to the next slide here. Federal Deposit Insurance Corporation, right? Everyone knows the gist of it. Your bank fails, you get your money back. So for consumer, non-businesses, we're going to talk about how to ensure our accounts are titled correctly. I know this may seem very elementary, but I cannot tell you. We'll get into some of the aha moments that even the basics of account titling can yield you in FDIC coverage. Benefits of revocable trust accounts. And the FDIC actually has a FDIC estimator or calculator on their website. You can even type in your institution, type in how your accounts are currently structured. It'll spit out what your FDIC coverage is. And then business and commercial deposits, we're going to talk about how we can get you up to $150 million worth of FDIC coverage. So anyone here have a living trust? Good. Did you fund your living trust?
Did I fund it?
Did you retitle your assets in the name of your trust?
I did.
Okay. I don't expect anything less.
I did, yes.
You walk out your estate planning attorney's office that you paid them thousands of dollars for with a big binder, and they tell you, fund your trust, retitle your cars, your bank accounts, and your trust. You would be shocked when people don't, right? So let's just use an example. Patrick goes to Bank of Anna. I have an account in my name solely. What's my FDIC coverage? Anyone?
150 million?
250.
That's me, 250,000, correct, right? My wife's name is Caitlin. Caitlin and I come to the Bank of Anna. We open up a joint account. Patrick and Caitlin, what's my coverage?
500.
Perfect, right? Patrick and Caitlin have a revocable trust. We get to double up on that. So my coverage is 500,000 as the trustee, co-trustee. Let's say I have 5 beneficiaries in my trust. We only have 1 kid, thank the Lord, right now. So I have 5 beneficiaries on my end. They each get 250 apiece. Caitlin gets to double up. She has 500 herself as a co-trustee. Same 5 beneficiaries that Patrick has. They get 250 apiece. 1.75 million for Caitlin, 1.75 million for Patrick. FDIC coverage, 3.5 million on personal account types. If your estate planning attorney told you, please add your trust as a paid on death beneficiary, I need to talk with you and your estate planning attorney, and I want to buy them coffee. It works in theory, does nothing for your FDIC coverage. Paid on death beneficiary. I'm not an attorney, I'm a banker, disclaimer, but unfortunately, businesses are not treated the same when it comes to consumer type accounts for FDIC coverage. If you read anything about Silicon Valley, you probably noticed a lot of tech companies that had high exposure on their deposits to the tune of 500 million or north, right? Unfortunately, they're not granted the same coverage as personal accounts, which I disagree with. I think businesses should have every single coverage that consumers do. So let's take, for example, $150 million in your illegal drug enterprise that you're running, but you're reporting on your taxes. So you're safe. Right. 150 million. So divided by 250,000, that's 600 or so different accounts. I don't know about you, but I do not want to open up 600 different accounts at 600 different banks. Bankers Trust Treasury Management Team will do that for you. So we have a program called an insured sweep account, where we essentially have a program with 3,000 partner banks. You get the convenience as a business owner to have one account on your dashboard, almost like a shadow account. You don't look at all the 600 different accounts. We do the legwork. We spread your deposits 250 apiece on a ledger, if you will, with other banks. If you already have an account at another bank, we'll skip that one, go to the next. Much better way to manage cash, provides a lot more business continuity. As you can imagine, if these big tech companies that had millions of dollars, hundreds of millions of dollars at Silicon Valley, operating account, payroll account, right? I don't know about you. If I was running a business, I do not run or write payroll checks. I have 600 different bank accounts. So mind you, if your accounts get frozen up when FDIC comes in, you're losing business continuity there. Our treasury management team can provide some solutions there as well. So on the next slide. Customized financing. So securities line of credit we're going to talk about. I will not bore you to death on HELOCs and PLOCs, I promise. We all get the gist of those. Business term loans, lines of credit, and commercial business real estate loans. So securities line of credit, most of you have probably heard this before. It's different terms used by different entities or banks. Sometimes they're called margin lines, right? Your name?
Marquita.
Marquita, okay. Marquita has $3 million under management at Bankers Trust Wealth Management Team, right? She comes to me and says, calls her favorite private banker, says, Patrick, I want to buy PJ, private jet, right? I do not want to go through the due diligence process of obtaining traditional plane financing. Does anyone know that is a complete pain in the neck? Probably twice as more difficult as mortgage.
Really?
Yes, yes.
I did not know that.
$3 million with us between cash equivalents, stocks, bonds, and her wealth management account. We will turn around in 48 hours or less. Give her, let's say her private jet loan is $1 million. We can turn her into a cash buyer by leveraging her assets, right? So her assets are the collateral we use. They're with Bankers Trust, almost no underwriting. Turns you into a cash buyer for either large assets, high dollar amount assets, or just an asset that just requires a, for lack of a better term, pain in the neck process to obtain traditional financing for. Home equity lines of credit, personal lines of credit, home equity lines. This is where Guild Mortgage and I might partner up, right? If Annette and her team gave somebody a kick butt interest rate 3 years ago, I don't know, 3%. Now you have all this equity in their house and they want to take it out, right? And that, what would the cash out refinance be if they had perfect credit, even
Oh,
5.5%?
Oh, no, it's more than that.
Okay,
It'd be
all
like 6, 7.
Sixes,
All right.
Yeah.
So we want to double their rate just for them to get their cash out, right?
Right.
So we can provide a solution there for you. Get your cash out without touching your first mortgage with Annette. Unsecured lines of credit, personal line. We're one of the few banks that still offer unsecured lines of credit, either at prime or a small margin. And then business term loans. These are going to be our business banking team. So, Annette, correct me if I'm wrong, your world is 1 to 4 units when it comes to Fannie Mae, Freddie Mac insured mortgages, right?
Correct.
So our business banking team would be able to help out with investments here on higher than 4 units, your sixplexes and so forth, your investment properties of that nature, and then lines of credit as well. And then our we have a commercial. I believe Tiffany had asked about our commercial team. These are going to be your service industries that we can provide financing for. Typically, your veterinary clinics. Does anyone know what the most difficult industry to underwrite a property for, by chance?
Sure.
Hospital?
Church and gas stations.
Gas stations is one of them.
Gas station? Really?
All hundreds of gallons of fuel on the ground.
Oh, yeah. Fire hazard.
Dry cleaners.
Dry cleaners?
Chemicals. Or is it
You
like
think
money
it's
laundering?
Poisoning.
Are
Are you returning in the same calendar year?
Money laundering. That's funny.
You know, you think like just the emissions of chemicals would just be destroying the air we breathe, but they seep into the soil. Not the soil, the real estate. So anyways, banker nerd out.
So that's, so legit, that's with dry cleaners. Wow. Wow.
And I may be speaking out of turn. I'm not a commercial banker, but it's been done. Just very lengthy due diligence process.
Wow.
Yeah.
Wow.
And then our commercial real estate team as well. These are going to be your 100 unit plus apartment complexes. We will also provide financing for that. Phoenix is, I think, the 5th largest city now in the U.S. We took over Philly a couple of years ago, I think. So everyone here in the room, I think, is on page with that, on board with that, right?
Yeah.
We'll go to the next slide here. So again, I told you I'd rather talk to you about case studies than bore you to death with checking accounts and savings accounts here. So this is really why I like what I do at Bankers Trust. We get to work with very unique situations. I mentioned South Dakota Trust and how we can offer just a slew of solutions for the business owner, the entrepreneur, the ultra affluent clientele. So I'll give you a case study here when it comes to South Dakota. And mind you, there's so many different variables here. Of course, I can't give you the specifics, but business owner of a home maintenance company comes to Patrick and says, it's time for me to sell my business, right? The payday is going to be about $15 million. And I think this is where typically bankers get tunnel vision. Bankers, unfortunately, always get focused hyperly on the credit life cycle stage of a business owner, right? How can I give you your next loan? I would argue that we need to be in front of business owners as a banker for this very reason of my case study, even towards the end of selling their business. I have all the respect in the world for business owners. I don't know what the statistic is for, 80% are, small business owners that run the economy versus large corporations. So I love them to death, but I like helping them too, because they get a little bit of tunnel vision themselves, in the sense of, this is my retirement, Patrick. Which very much is, but we need to put some steps in place, because quite frankly, there's not just going to be a buyer like there would a house in Chandler or Tempe or Phoenix and an open house, right? If you're going to sell a business, that process looks a whole lot different. So business owner comes to me and says, hey, payday is going to be at $15 million, right? I think any financial advisor, unfortunately, well, not anyone, I think most financial advisors would tell this business owner, I am so sorry. you have to take this tax bill on the chin. Not true. So the beauty about South Dakota Trust is we can offer a la carte services. If you have your own financial advisor, if you have your own CPA, if you have your own accountant, if you have your own estate planning attorney, we can still help. You don't have to use Bankers Trust financial advisors for this. So in this case, it was a trust administration role, if you will, from South Dakota, where the financial advisor of this client actually structured an Arizona installment trust, right? So the sale of the business took place within an installment trust. Really slick because the business owner can now take annual distributions instead of taking that big payday right out of the gate. Financial advisor can dial up or down distributions based on the needs of the client. You take that Arizona installment trust, move it to South Dakota, and administer the trust with no state tax, no capital gains tax, no estate tax.
Wow.
$3-4 million saved plus on a $15 million sale. So all perfectly legal. That was very exciting to me to be able to provide a solution for that. In case study 2, so privately held stock financing. These are typically going to be your, especially out here and maybe even like Midwest or East Coast, Aldi's grocery store, Winco grocery store, employee owned, right? Or just simply privately held companies. So these typical companies, right, they either award their employees stock options, physical stock certificates, where, you know, maybe they're awarded them as part of their annual bonus. Perhaps they have the right to purchase them at a certain point. What do you really do with the stock certificate, right? You kind of like traditional stock market, right? If I buy Apple stock today, I hope that it'll be worth more tomorrow, right? If I'm awarded these stock options for ABC company, and I want to retire on these, I'm going to work at a company for 30 years. Hopefully they'll be worth more than when I was awarded them or bought them for, right? But what do you do in the meantime? You have a stock option that's worth its weight in the certificate that it comes on, essentially, until that. Kind of like your home, right? Everyone in Phoenix and I can walk around and say my home's worth $500,000 at least. You don't have $500,000. Sure, you can put it on your balance sheet as an asset. You don't have to cash out, you know, unless you talk to Annette, unless you talk to Patrick to get your cash out of it, right? We'll come in and we'll provide financing on these stock options for companies like this. So this is a win-win-win, I think, for one, the business owner, right? The business owner, they have happier employees because their employees get to have a liquidity event. I love that term, liquidity event, right? I don't play the lottery, but maybe a liquidity event someday. But so their employees get a liquidity event. The employees are happier. They want to stay longer. They want to keep buying stock options because they now get to use their stock options until they retire. They still have control of the underlying asset, the stock option itself. It's an obvious win for the employee. They could have a liquidity event. They can go buy the private jet, you know. And I think that maybe a fallacy between. It's usually thought of as these are typically highly compensated executives that are awarded the stock options as part of their crazy salary package, right? That's not always the case. Yes, we do work with those folks, but these are also just any privately held company that does offer employee stock options. So it's a win for the bank too, because we get to produce we get to make an income producing asset like I loaned Anna her gas loan, right?
Yes.
We get to stay safe on our balance sheet, you know. So and these companies are also hand in hand with your ESOP, your employee stock ownership plan, which we also help with companies with as well. So I believe that is actually wrapping it up. I did ask everybody to think about what their biggest pain point was with their bank when it first started. If you yourself or you have a client, we would love to earn your business. You know, all jokes aside, I don't like to speak ill of my competitors, but you know, times are changing, right? We've all been through the pandemic when it came to PPP loans. I think a lot of us saw a lot of good when it came to the smaller community banks. Jason is here with me. He's one of our retail relationship bankers. So I told him to lock the door at the end, the timeshare style. Hard close everybody. Yeah, right now is a good time, right? If we can be of service to you or clients, we'd love to earn your business. I'd love to talk more. I want to leave time for Annette here, especially for Q&A, maybe at the end of both of ours, or should we do it?
Let's do it now.
Okay, yeah.
Anyone have questions for Patrick? Anyone online have questions for Patrick?
I didn't do that.
I thought you did a great job.
Yeah.
I have questions about the business financing.
especially when it comes to things like the ESOP. How often do you see employees use tools like that to be able to purchase a house?
Often, same with the securities line of credit, right?
Mhm.
I cut my teeth in financial services when it came to, I was in mortgage, right, with big bank. And so that was always a slam dunk at the big bank, right? Especially for maybe construction financing. You know, everyone in here has an idea of the pain that construction financing involves, right? So maybe they'll take a loan against their assets to start the construction financing and then obtain, you know, post financing through a company like Guild. So, but to answer your question, we do see it often, and it 9 times out of 10 is to purchase a large asset. Rarely do they go through the process, and I will say it is an easy process because it's much like the securities line of credit when it comes to the stock financing, because our collateral is easy peasy, right? It's your stock certificate. If the company says we'll buy back your stock options at 85% of value, that's where we're going to set our loan to value at 85%. So we're very conservative in that sense, but it makes them, I always say this, if it makes sense for the client and it makes sense for the bank, we're going to wrap our heads around, right? So often, yeah.
Gotcha. So it sounds like your underwriting is super quick. And what do you think the size, with your size of company, which seems like it's more of a mid to smaller
600-ish employees.
Okay,
Yeah.
all right. So it's tight knit. You know who to go to. You have direct access to whomever that person is that's underwriting the loan or has that decision making. Are they local? Are they out of state? What does that look like?
Yeah, so we are based out of Iowa, right?
Yeah.
So with banking, I think, and coming from Chris is responsible for recruiting me over to Guild years ago. So I will say it's very similar to the sense of Guild. I will get some kudos, right? You do have direct access to live breathing people here locally, right? Even though the company is based out of California. So very similar to that. A lot of our underwriting is going to take place in Iowa, but in the sense of a tight knit company like 600 employees, I mean, it's hard to run from me. Let's put it that way.
Yeah,
So, yeah.
right. Well, that's what I was thinking. I'm like, you really do have that direct access with it being a smaller company, which is nice. What's the most creative thing you think that you've run across with the different types of financing that you've seen?
I think that example of South Dakota Trust probably tops my list.
I know. I'm sorry.
If it's not South Dakota Trust, I feel like I'm repeating myself. It is using one of our revolving lines of credit options to either get you over the hump when it comes to an asset purchase. You know, most people, I think they just assume like I have to go the traditional financing route. Yeah, I would say either the securities line of credit has worked wonders for people because that is almost a 24 to 48 hour underwrite. And then anything with South Dakota Trust is just, that's when my banker nerd brain goes crazy. So yeah.
Awesome.
Yeah.
Awesome. Okay, I'm gonna put you on the spot again.
Okay.
So sorry. HELOC.
Yeah.
Where approximately are your rates
Sure.
or margins with HELOCs right now?
6.99% fixed for 2 years. That's a 10-year line. So we'll do Wall Street Prime after the first 2 years plus a margin, typically 1.25%.
Does the client have to have an account relationship with you?
We obviously can't make the customer have a banking relationship with Bankers Trust. It is the only, I shouldn't say that, it's the easiest way to access your HELOC. We don't offer HELOC checks anymore, unfortunately, just as a security measure. Someone steals your checkbook, writes a $100,000 check out of it. That's bad news, right? If it's tied to your HELOC. So we do encourage a checking account opening simply so you can draw on your line of credit, advance it to your checking account as an extra security measure, write checks out of it, wire ACH out of your checking account rather than draw on your line. But it's, again, not required. Otherwise, you're going to be limited to coming into the branch for bank checks every time you want to draw on your line of credit. So,
Gotcha.
yeah.
Gotcha.
Is that a 10-year line with a balloon or?
10-year line with a balloon.
Okay.
What we see most often is, and I don't think I've ever dealt with one that went the full term. It's usually renewing it. a certain point in time, mainly because they have bigger equity in their house, no one then clears their credit limit on it, right? So yeah, balloon payment at the end. There is an option for a repayment, or it actually is what we call a workout loan. I know a lot of banks do like a 20-year repayment phase after it. We don't do that, but there is an option with a principal and interest fixed repayment term if you wanted to work that out. More popular is we're going to either renew it, if we have a smaller balance on it, go ahead and, pay the balloon payment off. But usually renewing it, that way you can increase your credit limit, extend it out however many. I have no idea what rates are going to be tomorrow, much less 10 years. So
Right,
Yeah.
right. Well, that's a really nice feature for it to be fixed for 2 years.
Yeah.
What about the stock, the stock, you said it's basically prime,
Yeah, so we're going to underwrite a stock loan like we would a
so
PLON.
basically it's at 8% today. If you
Yeah,
can do, okay.
right. So prime's at 8% today. Next Fed meeting is in a week or two. So, right. So yeah, we're going to underwrite that the same as an unsecured line of credit.
Okay.
Even though it is secured by the stock, there is collateralized. I think that's between the HELOC and a PLOC, right? Because if we did default on it, like, sure, we can take your stock, but again, like, we're going to sell it back to the company at 85% buyback value, right?
Right.
So
So if you're doing an unsecured line of credit as opposed to margining something, someone that doesn't have assets with you. So how are you underwriting an unsecured line of credit?
very possible. It is getting tough. Most banks, I think, strayed away from unsecured lines of credit simply because there's no collateral, right?
Yeah.
In their minds, I think, and I can only speculate here, it's why offer 5%, 10%, what have you, on an unsecured line of credit that is not a card account, right? We are going to qualify you on a 36-month amortization per payment, which can be difficult. So you are going to have either high income or low debt or both. But it's actually a 2-year line, 2-year term line, but we qualify on a 36-month amortization.
I got you. Is that a prime plus something?
Yeah, depending on your qualification, again, like pricing, as far as if you had D50 FICO and you're 10% DTI, you may just be a prime, floating prime.
I got you.
Where anything probably less than that, maybe a quarter margin added to it.
Gotcha. So you're doing like a DTI of
43%.
43%. Okay, so you're using QM kind of a
Yeah,
DTI.
right.
Okay,
Yeah.
I got you. With a 36-year AM.
Right.
At what?
Qualifying wise, but
Right,
term
yeah.
wise too.
Right, yeah, okay.
We don't want to end up like Silicon Valley in the news. So
Yeah. Right. Exactly. No, that's awesome.
How
Well,
much are you
thank
doing? How much of that are you doing very much of that, or is it mostly margining things for people who have assets with you?
mainly HELOCs,
That's right.
just because it's 699 fixed for
Gotcha.
years, right? And you
Doing
don't
that.
need that versus floating prime. I think a second to that would be the securities line, just because it has more capacity that you can get on a loan compared to an unsecured line, especially if you have an intention to make a purchase.
What kind of credit minimum do you have for that product?
Unsecured?
No, your typical HELOC.
720,
Okay.
low sevens, right?
Okay.
Again, I say if it makes sense for the bank, it makes sense for the client, we'll wrap our heads around it. Coming from the big banks, it's like, I check every box, but their credit score is 739 versus 740. I think most big banks kick it to the curb.
Right.
Well,
So you look at
We'll talk.
especially if you had a real low LTV.
yeah. Or if you had, if you had a banking relationship to us, that's with us, something we'll consider as well. Yeah.
Cool. I think that's all the questions I have.
Okay.
All right.
Well, thanks so much.
Oh, yeah. Thank
Appreciate
you, Patrick, very much. Very interesting. I'm like, ooh, ESOP. I'm like, ESOP. I'm going to have you, you switch it up. What I did was I put together just some of our more unique products that we've got. I'm not gonna go over our regular stuff that we've got. Your typical FHA, conventional, USDA, VA, even the buy down, I think, is tired right now. I think that's a tired one at this point. Now, we do have a product that does have a buy down in it that is unique to Guild. So we will definitely take a look at that. But go ahead and put it on the first slide. The first slide.
Sorry, it's going through.
Oh, it's trying
It's
to
on
do it.
slideshow.
Oh, got it. So the first one we've got is an internal bank statement program. Credit scores as low as 700, 12 to 24 months, personal bank statement. We also have to verify the business option for 2 years. So we would have to take a look and see if their business, if they've been in business for at least 2 years. So this is, we haven't used this one too often, but we do have it available. We've also found some of them are better when we broker them. So there's some better options when we broker them. So, and we have actually been brokering quite a few loans lately just to get more people into homes because of some of the unique products that they have. Go ahead and go to the next slide, Anna. 321 Home. We've used this one quite a bit this year. It came back out December. I think it was December. This one came back out. Really great program. 3% down on a conventional loan. First-time home buyer. You've got to have a 620 or better, so you don't even have to have perfect credit. Although I would say that it's a little sticky to get that low. There's got to be a good reason for your score to be that low, or you have to have like ginormous amount of reserves to get that low. But it's a really great program. A lot of our clients have, those that have taken advantage of it really like it. $2,000 gift card to Home Depot, and anywhere between $1,000 to $2,500 towards closing costs or down payment.
Sorry.
That's okay. I know it's not you. I know it's not you. I know it's the slideshow. So Cash Pass. I think this is going to become a thing in the near future again. Now, it's a very interesting program. It's not the most user-friendly that we've got, but it's very good when you have a seller that needs to sell the house and it's contingent and you've got a buyer and you need everything to fit perfectly. I think this is going to make a comeback probably a little bit later on this year, believe it or not, especially with our tight inventory. So we'll see how that goes, but this is definitely an option. It's for any conventional program. It's for primary residence, second homes or investment properties, credit scores as low as 680. There is a bridge loan option. So if you are looking at if you're in a multiple offer situation, this is the product that we can use. So, you know, it's almost as if the seller or the buyer is going in with cash, which is super nice. Go ahead, Anna. Complete rate. This is for our borrowers that don't have any credit scores. Believe it or not, I actually pulled one this morning. So there we go. You know, very interesting. They would be an FHA buyer, down payments with as little as 0 down. That's for our USDA and VA clients. This one in particular, FHA, 3.5% down. We'll look at the income and debt through bank statements and in an analysis process through their bank statements. And this is for first-time home buyers only. So this one's a very unique product. Not everybody has it. But I think it's an opportunity in the marketplace to get more people into homes for sure.
Oh, it didn't do it that time.
Oh, Green Smart
Advantage.
It did. Green Smart Advantage. Now, this one is a very unique one. This is FHA, and it's for first-time and repeat home buyers. You can actually finance. Energy efficient appliances into the home, which is really nice. So you're walking into a house that might need some repairs, or maybe it needs some upgrades, or maybe you just want to tear the whole thing out at some point, but you want to save a little bit in Green Smart savings. And so this would be the one that we would use. Obviously, credit scores as low as 580, and there's some really good home improvements to be made when doing this. And I think it also includes like the temperature, like your
Oh.
yeah, thermostats, like the smart
Smart.
home technology piece of it. Yes. So yeah, so it's a really cool product. We do have home equity loans. However, ours is not as great as Patrick's. So I was very interested. I'm like, okay.
Credit scores as low as 660 though. So
Yeah, but we do not have to, 6.99 locked for 2 years. That's amazing. So we did just come out with a in-house, well, it's really a brokered product. It's a standalone product. However, the margins and things like that aren't as good. And when we know someone like Patrick that can do a really good job for our clients that are that have cash, that have good credit, I think that that's a very good option. So, and it's all about having resources too, right? When you have a bunch of resources that you can go to one person or another for different things, it's always good to have good friends in the business. So payment advantage. The payment advantage is really great. Credit scores as low as 620, is little down of 3%. The payment advantage will reduce your rate by 1% the first year. So this is your buy down. Guild is doing the buy down for the first year to be able to help clients out during what we've had as far as an increased rate environment. What's also nice about this too is that from now until the end of July, you can refinance with no lender fees until the end of December of 2025. So that's another feature for any purchases that we are keeping in-house. We have to keep the loan and things like that, but yes. And don't get me wrong, if it's on a product that we sell the servicing, we'll figure out a way not to charge them lender fees. So especially for repeat clients. Payment Advantage Plus. This is really interesting. So if the seller is giving them 2% towards their cash to close, we can use that to buy the rate down the first year at 2%, and then Guild will put 1% on top of that. So they'll have the 2-1 buy down versus just the 1 year buy down. And same thing applies with refinancing. As long as they purchase between now and the end of July of this year, they'll be able to refinance up until the end of December 2025 and be able to not have any lender fees. Jumbo loans. So we've gotten some pretty interesting jumbo loans lately. I did see one that we have access to that is 95%. So there are some interesting features on these. Some of the uniqueness that we can do as far as products go do come with broker options. So we do have a broker option that's 90% or 95% LTV. I was diving into a little bit of the quirkiness of it. So it's definitely very individual people. So it depends on the scenario. Manufactured homes. Oh my gosh. Manufactured homes. Everybody wants affordability right now, right? So manufactured homes are one of those unique things. Not everybody can do them with as little of 0 to 5% down. Some people cannot do single wides. We can do single wides now. So I know that that was probably a change from when you were at Guild, Patrick. And so there's all kinds of really cool things that we can now do with manufactured homes. I will say that our cross mod and the newer manufactured homes coming out now are beautiful.
They look like a normal stick build house.
Yeah,
That's cool.
yeah, they really are very nice, and they're very energy efficient. So those are definitely some good options. I-10 program. I-10 program in credit scores as low as 660, loans amount up to $1.25 million, up to 80% loan to value, so 20% down. This offers those clients that do not have really they're not citizens. However, they work here, they live here, they pay taxes. I mean, we had to have a program like this. And so they brought this out, I think, the end of last year. So very good program. Renovation programs, we still have renovation programs for FHA and conventional. There's a variety of improvements that you can do, including pools unconventional. So I think we could do them on FHA. Anybody remember? Yeah, so very, very good. Next one. Reverse mortgages. So we have a broker option right now. However, we just acquired Cherry Creek. Cherry Creek is bringing on a big reverse mortgage division, which from what I hear, we're going to have a product at Guild that's in-house fairly soon. So reverse mortgages in the future, I think, are going to be a big deal, a very big deal. And so if you have a client that's over the age of 62, this might be the product for them. I like reverse mortgages for elderly clients. It really depends on their situation and what they need, but reverse mortgages are fantastic. Go ahead. Oh, I already did that one. Down payment assistance. Oh my gosh. DPA program. So there's another slide in here. We have the regular ones that everybody uses all the time, Home and 5 and Home Plus. That's what this is about. 640 credit score, debt to income ratios can't be over 45 to 50. And there are income limits. I think the new income limit now is 125,000. However, we have a new DPA program. We have access to the Max One program. The Max One program is very interesting. 600 FICO minimum, 100% CLTV, meaning they will give 3.5% the total down payment on an FHA loan. This is very specific to FHA, where the other ones you could do FHA, VA, conventional. This one, you can actually buy down the interest rate if there's seller contributions. And in fact, I don't even think there's a rule on this one that it has to be a seller contribution. The buyer can actually choose to buy down the rate. The rate is very comparable to Home Plus and Home and 5. It's got, you can amortize the payment over 10 years if you want the payment option. If not, it can actually be refinanced into the loan at a later date. So if they hang on to the property for 3 years, and they're like, hey, we want to take advantage of the lower rates, we'll refinance them and we'll take whatever that balance was of the down payment assistance and roll that into the loan. So they don't have to pay on it, or they do have the option to pay it down for 10 years. So that's a really good one. General eligibility requirements. This one is for, oh gosh. Oh yeah, MCC program, super awesome. That hasn't been in Maricopa County it's only been here for like 6 months. So it's been down in Pima. It's been down in Pima County for a while. Maricopa just got this about 6 months ago. It's a great program, adds about $166 to someone's income every month that we can push if we're tight on debt to income ratios. So that's a really, really great program. And it's very cheap. It's actually super cheap to be able to do this. So.
Oh, you pulled up your slide.
Oh. Oh yeah, that's right. I forgot to pull up the other one. Whoops. You can you can unshare now for sure. But if you guys have any questions, please reach out to the loan officer who invited you. They are the biggest resource of creative financing, right? They know all the gray areas. They absolutely know all the gray areas. They know where those clients would fit best. And I really feel like the loan officers that we have here are some of the best in the business. So reach out to your loan officer and whoever invited you here today and really get with them, and especially on those specific questions and information. Like it's very valuable to be able to reach out to them because they're going to know what to do. Any questions? Oh, okay, cool. Any questions from you guys? No?
My brain is jello right now, so.
Oh, okay.
Is that due to me?
Yes.
I'm gonna put you on the spot since you put me on the spot.
Okay.
Loan level pricing.
Oh, yeah.
What are your thoughts?
Oh,
Yeah.
my goodness. Oh, my goodness. Loan level. I love loan level pricing adjustment.
Good answer.
Yes. Well, we don't have a choice, right? I mean, yeah, you have to just embrace it and run with it. You know, it was recently politicized over the last couple of weeks. All of a sudden it's in the headlines and we've known about it since February. So, you know, and I think the headline that came out is Biden is
Making good credit borrowers pay for low credit borrowers.
yeah,
That's
yeah,
basically what it
something
is.
around that, penalizing great credit clients, right? Which I don't, when you look at the chart, the actual finalized chart from what they put out, it's not really that at all. They did raise the actual LLPAs for the higher credit clients and lowered the loan level pricing adjustments for the lower credit clients. However, they still have to pay a lot of money. So I do not suggest anyone go out there and wreck their credit. Do not go out there and wreck the credit because it's not going to help. It's just going to make it worse, you know. And to be fair, I think it will put more people, it will help a little bit. Like, I don't think it's going to make it, I don't think it's a drastic change to help somebody in a lower credit score request. They might as well go FHA, to be honest. They're not going to get approved through underwriting, through automated underwriting for a conventional loan.
Is it gonna affect both rate and insurance, mortgage insurance, or just mortgage insurance?
Right now, it's just affecting interest rates from what I can tell. I have not really seen too much of a deviation on MIP yet. So I don't know, has any of you seen that? Yeah, I have not seen the changes on MIP, but definitely on interest rates, yes, absolutely. The one thing that's interesting though is the debt to income ratio LLPA, anything over 40% was actually moved until the end of August. So they had that one scheduled in there, which is just everyone in the mortgage industry, real estate industry really started to complain about that particular LLPA, just simply because our systems to try and adhere to that particular loan level adjustment, like it could be as simple as an underwriter reworking our income. So if our income's not perfect from the time of pre-approval, and you have an adjustment in that, and then it adjusts the debt to income ratio over 40%, you're going to have that extra 3/8 of a percent hit to the interest rate. And that, so needless to say, Fannie and Freddie decided to move that decision out until August to get everybody ready and prepped for it. So yeah, LLPAs are a big deal right now. Well, it's all the talk. I don't think it's a big deal, but it's all the rage and all the talk right now because someone decided to politicize it. That was it. That's my thoughts. I mean, I could go into more about it, but I won't. I'll leave it on the down low and the, you know, that in that sense.
It's a Teams chat, not a Zoom chat.
Okay. Any other questions? No? Okie doke. Well, thank you all for coming. Thank you for whom joined us on Zoom. I appreciate you coming. Please reach out to your loan officer and thank them for being here as well. And hopefully we'll see you all next time.